When doing asset-specific analysis on stocks and corporate bonds of a given company, we should investigate the company's financial statements. Financial statements of companies are issued 4 times per year and disclose their financial health, which is crucial to the value of the company's stocks. There are 3 types of financial statements. Income statement includes elements such as revenue, expenses, and net income, loss for a given time period. Balance sheet includes 3 major components: assets, liabilities, and owner's equity. It reveals the financial structure of the company, what proportion of the company's funds come from debt, bank loans and bonds, and from equity, stocks owned by shareholders. Cash flow statement illustrates the flow of the most liquid asset any company has at its disposal, cash. The cash flow statement complements the income statement and the balance sheet in a number of ways. Financial ratios are derived by dividing separate entries from the financial statements. For example, take a company that has $1 million of profit. In order to say if this is good or bad performance, we should put this profit in the context of how many assets the company has. For this reason, we calculate the profit over total assets ratio. Financial ratios are relative measures. They create context of the separate values in the financial statements. Financial ratios are intended to yield a comprehensive picture of a company's financial position. Based on what each ratio is intended to measure, they are systematically organized into subcategories: liquidity ratios, solvency ratios, profitability ratios, asset management ratios. As mentioned in Level 1, liquidity is the easiness to convert an instrument into cash at a given price. Whether or not a company has liquid assets indicates whether it is ready to withstand tough financial times. Liquidity ratios measure the ability of a given company to react if it faces unexpected need for cash or if it has to service debt. The most popular liquidity ratios are current ratio, calculated as current assets divided by current liabilities; quick ratio, calculated as current assets minus inventories divided by current liabilities; operating cash flow ratio, which equals cash flows from operating activities over current liabilities. The higher the value of liquidity ratios, the better. Solvency measures the extent to which a company is threatened by bankruptcy. Solvency measures the risk associated with the type of external financing the company engages in, whether it is appropriate to issue stocks or bonds, and whether this threatens the existence of the company. The lower the bankruptcy risk, the better for the company. The most popular solvency ratios are debt-to-equity ratio, measured as total debt divided by total equity; debt-to-asset ratios, calculated as total debt over total assets; times interest earned ratio, measured as income before taxes divided by interest expense. Solvency ratios must be interpreted in context. Sometimes, high amounts of debt are not necessarily a bad sign. It might be that the company is undertaking investment in new projects, which might eventually turn out to be profitable, and to raise the stock price. Profitability ratios are used to measure a company's efficiency in generating profits. As profitability is the most important determinant of a company's stock price, profitability ratios should be closely monitored. The most popular profitability ratios are net profit margin, measured as net profit divided by total revenue; return on assets, ROA, which is net profit divided by total assets; return on equity, ROE, calculated as net profit divided by total equity. The higher the profitability ratios, the better for a company and its stock price. Asset management ratios, as their name suggests, measure the company's relative ability to manage its assets at hand. Asset management ratios serve as a comparison point on how well a company is able to take advantage of its assets and generate sales and profits from them. The most widely used asset management ratios are inventory turnover ratio, measured as total revenue divided by inventory; receivables turnover ratio, calculated as total revenue divided by receivables; number of days of receivables, measured as receivables divided by average revenue; number of days of payables, which is payables divided by average revenue. DuPont analysis is a simple mathematical equation that illustrates how the return on equity, or ROE ratio, can be broken down into 3 financial ratios. These ratios are net profit margin, net income over sales, total asset turnover, sales over assets, and financial leverage, assets over equity. DuPont equation, ROE equals net income divided by equity, equals net income divided by sales times sales divided by assets times assets divided by equity. ROE is one of the most important ratios traders monitor. Therefore, breaking down ROE into subcomponents allows a trader to identify what the specific drivers behind a change in ROE are. Pros. Financial ratios provide a standardized measure that can be easily compared across companies and different stocks. Financial ratios reveal information that cannot be seen by merely looking at financial statements. Cons. Financial ratios are static measures. They only represent a snapshot of the past. Financial ratios can serve as a basis for comparison only for companies that operate in one and the same industry.